My next guest isn't overly concerned with all the shifting tariff rhetoric, but he is staying away from large caps because of it. Except for three names. For more on what makes them attractive here, let's bring in Jack Ablin. He's Cresset Capital's founding partner and CIO. It's great to have you here. Welcome.
Thank you. Thanks for the invitation.
Do you want to just kind of start with how you're thinking through all these tariff announcements?
Sure. I mean, there are pluses and minuses, certainly. I mean, one of the things that really stuck out to me was back in May, the Treasury collected over $24 billion in tariffs, and that's triple what the run rate was going into March. So I do think there will be some sort of offset. On the other side, of course, if you look at the kind of the array of CapEx spending plans, what I'm seeing is, not surprised, if you look at Richmond, you look at Empire State, it's coming down. So right. Northeast, a lot of the manufacturing there. If you look at Kansas City and Dallas, it's going up. So perhaps ramping up energy, cutting back on other traditional manufacturing in the face of these tariffs.
So you mentioned the $24 billion. This is going to be kind of the running theme throughout the show. I suspect we're going to talk to Maya McGinnis later on. But if we kept at that run rate, we're talking about upwards of $250 billion in revenue per year. Now, if all of a sudden what we're talking about goes into effect, we're going to be talking about even more. It's a benefit, I guess, from a deficit point of view. It's got to be a headwind to growth. How do you think through that?
That's it. So there's an offset, right? So it will be obviously higher costs for purchasing. It's in many respects, it's a consumption tax. So we will see. We've already seen imports from China down 30+% year over year. We're seeing households starting to cut back. And businesses, I know, are pretty confident they'll be able to pass a lot of these costs through as they did during the pandemic. But it's different. I think
I think it's definitely different.
I think that,
and a lot of people call this a corporate tax. I think it was Peter Bookvar who said he likens this to about a 10-point corporate tax hike, from 20 to 30%, really, because it's not clear they can pass it along. And if they don't, we know what that means.
Right. And so if you think about, it all comes down to earnings and profit margins. Now, the good news is, Mag 7 profit margins still continue to rise, but even large caps, small caps, and mid caps all rolling over. So that is a concern.
So this says you're staying away from large caps. Is that right?
Well, what we've done is, this was a shift that we made at the beginning of the year. What we looked out 10 years, this was before tariffs, before Trump, everything else, and we said, the next 10 years in the S&P 500, we expect to earn about 5.2% per year, just based on valuations and how things...
A little bit less than historically normal, correct?
Right.
Yeah.
At the same time, we look at 10-year BBB bonds yielding 5.3, and we said, okay, we can get 5.2 with a 20% volatility, or would we prefer to have 5.3 with a 5% volatility? So that was really a shift there. It wasn't necessarily, we're not passing judgment, but we just thought, based on those outlooks, that made more sense.
You were leaning into bonds and out of stocks at the very moment. A lot of people were doing the opposite. It does mention that there's three names that you were excluded from that. Are there three names that you think are particularly well positioned right now?
Well, we have a whole portfolio of names that share these characteristics. So what we want going into the back half of the year with, liquidity tighter than usual. The Fed is going to continue to, keep the reins on overnight rates until, of course, May next year, when who knows who comes in. And so so we want cash flow generating companies. We want high quality companies, and we want companies that are paying and growing their dividends. And so the three I gave out of the portfolio of 60 we have is IBM. It's still a good. They were one of the earliest AI plays, and they're generating a lot of cash. They have a 2.3% dividend, not growing dramatically, but still pretty solid. Next is Nucor. Why? Well, they produce steel in this country. So they're going to be able to raise, and of course, they're going to raise their prices as their competitors are forced to. 1.6% dividend yield, growing at about 1.8% per year over the next few years. And then lastly, Chubb, property and casualty, great cash flow generator, 1.4% dividend yield, growing at 8%. We expect to grow at 8% per year.